Hi there, James from Game More here, and for this week's video, we're going to do something slightly different. And rather than have a sort of talking heads piece, I want to take you through a question that gets asked of us as a business consultancy, predominantly by lots of startups or people looking at starting their business, and they've got this idea on creating a company, and they're not 100% sure as to what sort of status the company should have. Now, they've got the idea, they know what they want to do, but it's about actually what is the best organizational status for us in order to be successful and to be compliant. And there's sort of four key statuses that any company can have. So, what we have here, we have the sole trader, we have a partnership, we have a limited liability partnership, and we have a limited company. Now, what we're going to do in the next sort of 2 or 3 minutes is to go through what each one of those actually mean and the advantages and the disadvantages of each of them. And then once we've done that, we're going to look at VAT really, really briefly. But by the end of this quick video, you'll then know if you're about to start a company, which one of these best suits you. So if we first start looking at the sole trader is someone who is self-employed and runs their own business as an individual. Now, they can actually employ people, but they are running the business as an individual. It means that you, as the sole trader, are solely responsible for the business and the profits, and more importantly, the debts that it would have. So, any losses made by the business have to be paid for out of the sole trader's pockets. Now, that might sound a bit of a negative, but let's look at the advantages. The advantages are that after you've paid tax, you keep all of the profits. You've got control of how your business is run because it's your business and you're the sole trader, and your business's data is kept private. So you don't have to share as much data with Companies House and therefore the wider world as you do if you are a limited company. The disadvantages, however, are that you are liable for any business losses. It can be difficult if you're looking for financial support from banks or institutions. As a sole trader, you have to jump through more hoops in order to provide stability to those financial institutes when you apply for funding or for credit. And the pressure for the business to succeed is actually all on you. Now, it could all be on you as a limited company, but as a sole trader, it really, really does fall upon yourself. So that's the sole trader. If we move on to partnership, and the colour scheme on this, guys, is there's no relevance as to which one's better or not. It's whatever suits you. But for a partnership, as it says on the tin, is where two or more people form a business, and all of the business partners share responsibility. Profits that are made are split between each partner, and they're individually responsible to pay their share of the tax. Now, the advantage of that, the clear advantage, is that you're sharing the burden of running that business with someone. And that's a case of the innovation of ideas, the implementation of projects, all of that. It's not falling on one person, it's falling on at least a second person in a partnership. The disadvantages is that you could end up with disagreements, as you would with any larger company. If you're the sole trader, it's your decision. If you're a partnership, there is a mutuality there. You need to talk to your business partners. Um, Taxation laws currently say that all partners have to pay their own tax. So, despite the fact that you're in a partnership, the burden of tax relies on the individual. And if profits are exceptional, then the partners themselves are forced to pay more in terms of tax than they would if they were in a limited company. And there is a reason in terms of how you draw down your earnings out of a limited company that may be more of benefit than as a partnership. Now, the next stage we have is a limited liability partnership where the business is run by two or more people. The partners are not personally liable for debts that the business can't pay. The only liability you hold is the liability for the amount of money you've invested in the business. So, for instance, if you've put £25,000 into the business, your liability is maxed out at £25,000. The partners would agree profit shares and responsibilities as per their LLP agreement. So there is a liability there, but the liability, whereas as a sole trader is wholly on you, as a limited liability partnership, it's related to your investment in the business. The advantages: the liability of the business isn't down to one single person, so any financial issues or business responsibilities, they're shared. The flexibility of what and how much you contribute can be dictated to you individually. So there isn't everyone has to put in the same amount of money. And you can have as many business partners as you like in that. And they're really strong advantages. Disadvantages: some businesses and clients don't see LLP as a credible business. So if you're going to go from a sole trader, it might be better to go to a limited company. If you're dealing with companies and clients who might not see the LLP as an option, there's potential conflict because there's a lack of need to discuss everything in the business. And the further away from sole trader you get, the less conversations you need to have to decide upon actions. There is a challenge with the LLP. If members decide they want to leave, the exiting of that structure is a little bit harder than it is in a partnership or a limited company. So if we move to the final option, which is a limited company is an organisation set up to run a business. All the business's finances are kept separate to your personal finances. So once you pay corporation tax, the profits are available to distribute as dividends to shareholders. Now, currently, dividends are tax-free for the first 2,000, and then I think it's 8% beyond that. Now, at the time of recording. Things may change when you actually watch this video. A limited company allows the protection of your business name through Companies House, so you can't have replicated names, and you have the option to offer shares in your company to your employees. Now, that could be a real motivator. If you've got a startup that's going places quickly, you can give away equity in form of shares to get people on board, and they can earn from that at a later date. In terms of the disadvantages, there is a lot more paperwork that needs to be done. So you need to keep accurate records as you go along the year, and you need to submit data to HMRC at regular points. There is always that challenge as to how shareholding sits between directors, and a lot of the information that you create within the business in terms of the operational structure and the contacts will be held on Companies House, which is freely viewable to the audience. The one thing about limited companies as well is that the liability is held by the company. So if something was to go wrong, and someone was sued, then the company would be sued ahead of the individual. So if you're a sole trader, you hold the responsibility. As a limited company, you may be a director of it, but the challenge is against the company, not against yourself as an individual. So you need to go away and think about which one of those you want to be. The only other thing I'd say about this is, depending on your client base, your clients may want to look at a bigger organization. So they may be nervous to work with a sole trader, even though you are a sole trader, because of the size of the operation that you have. So you can actually make yourself look bigger than you are by being a limited company and run it as a limited company, but in the guise of a sole trader. So you've got to fulfill the requirements of a limited company. But if your audience doesn't really care about how big you are, if you're not dealing with corporates, then you could quite happily be a sole trader if that suits. But if you're dealing with bigger clients, blue chip clients, it may be harder to win business as a sole trader than it is as a limited company. Hopefully that all makes sense. So any questions, queries, drop a quick email through to hello@gainmoresolutions.com and we'll answer it for you quite happily. Just want to finish off the video with a VAT angle. So to VAT or not to VAT, that is the question. There's some advantages and disadvantages. So the advantages of being VAT registered, and this is not a finite list, but just some of the things here. So you'll appear to be a bigger business if you charge VAT. So as we said about the limited company situation, being registered as a limited company makes you look bigger. If you are registered for VAT, the expectation is that your turnover is over £85,000, which is the legal level that indicates a business has to be VAT registered. So if you're doing £70,000 a year, you don't have to be VAT registered. If you're doing £100,000 a year, you have to be. And companies may, if they're turning over less than £85,000, still be VAT registered. It doesn't involve more paperwork, but it actually makes you look bigger than you are. And if you're a small company starting up, dealing with corporate clients, dealing with big clients, and there's an expectation where you're financially stable and structurally you're okay, you may want to take that decision that the pain of the extra paperwork for VAT registration will actually help you to look bigger than you currently are. If you sell to VAT registered businesses, you can reclaim the VAT. So your selling price is competitive and you'll be able to recover the VAT on your costs. If you maintain up-to-date records, you provide better information for running your business, so you'll be able to see your cost base. If you are not charging VAT but being charged VAT, there's a gap there. And the idea is always to be able to make that as neutral as possible. You probably will never ever zero your VAT. You'll either be in a surplus or deficit, depending on what you charge and what you buy. But the idea is if you've got that, you can then start seeing where your VAT is coming from and going to. You can claim VAT on certain items that you purchased prior to the date of VAT register. So if you're starting up and you've invested beforehand, you can claim that VAT back. You need to talk to your accountant about the exact details because that changes quite regularly. If you're in a VAT reclaim situation, you'll definitely be better off because you're actually taking VAT back from the government, and you're likely to receive repayments because your VATable sales are lower than your VATable costs. So you just need to be aware that there are different levels of VAT currently, and things are changing because of COVID. But the idea is that you can actually charge your services at the right VAT level, but you might be charging at 20% and paying on 5%, or charging on 5 and paying on 0. It just depends on how your service offering is versus your costs. The negatives, uh, there is an increase in admin and bookkeeping costs. So if you're able to do all your bookkeeping and your accountancy costs yourself and your accountancy yourself, great. Probably very little cost to you, probably more time. But if you've got an accountant, that will be more work for them. So it will cost you slightly more. But again, go back to why you're being VAT registered. Is it because you need to be over 85,000, or you want to be because you want to appear bigger? If your customers are not VAT registered themselves, and especially if you're in a B2C environment, um, you'll appear 20% more. So if you're a builder and you're VAT registered versus a builder who's not, your costs will appear more expensive, and that may be a challenge for you. There is an expectation that lots of people do that work with the trades, work with people who are quite VAT registered, but there's also a lot of cash in hand stuff that goes on. So you do need to have a balance as to why. Firstly, do you have to be VAT registered, i.e. your turnover is over 85,000, or do you want to be because of the size of the business, and do the positives outweigh the negatives? So in terms of that, we've just been through the company status. So what sort of company you should have as a startup? Should you be a sole trader? Should you have a partnership, a limited liability partnership, or a limited company? And then we've also then looked at VAT. Next video next week, we'll probably be looking at something back in terms of operational, but hopefully this has helped you, especially if you're a startup or thinking about starting a business and you're starting to think, actually, what type of structure should I have my organization as?